And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, where we talk everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we continue our 6-part series on decoding mortgage programs. And this week's episode, we are focusing on self-employed borrower mortgage programs. But before we get to that, Joe, I understand that your son, your oldest child, right? Yes. Tomorrow he's turning an adult. He's turning 18.
He turns 18 tomorrow.
Wow.
He was born 2000, or he was born 6/6 of 2006. So tomorrow is his 18th birthday.
Wow. So you're going to start charging him rent now, right?
Yeah. No, he's still in high school. He's going into his senior year of high school, so I can't do that one just yet. But
okay.
Knowing him, he would do it. He is a very responsible kid. I'm very proud of him. Glad the young man he's growing up to be. He actually had a conversation with me about life last night. We were doing a little side job, and he was just sitting there talking to me about things. And I was like, God, you've got a better head on your shoulders than I did at that age.
Oh, boy.
It's really nice. It's really nice. Well, you have a daughter in college, so you know when they turn 18, it's something different, right?
Yeah, it is. It is. She's my youngest. And yeah, when she turned 18 last November, which was in her freshman year of college, right, up there in Denton. Yeah, it's a different world. It definitely is. And I'm going to say it's different with girls than it is with boys. Right. With boys, my son, I didn't have to worry about him. You know, I think boys are easier to raise, bottom line, right? They just are. So
for anybody watching that has daughters only, you know, you can
give me a thumbs up if you agree with me. Okay. If you have a girl or a son or daughter, give me a thumbs up if you think that boys are easier to raise than girls. I mean, your daughter is what, a sophomore?
Right? She's going into her sophomore year. There's some things there that, you know, she is a very responsible young lady too. But you know, there's differences in the school and the emotions and the drama between a boy and a girl.
Oh, that's the big difference right there.
Yeah.
Yes. I think junior high was the toughest years for my daughter. Right. The drama with the girls. Everything, right? It just, I mean, they can be mean, right?
Boys can be mean too, though. I mean, we can't down all the women out there that were girls in high school. I mean, there's a lot of boys I know. Maybe some people would say I was one of the mean guys, but you know, we're mean too. But I'm excited to see what this next year brings to him. You know, and also the family. So
a lot of opportunity.
But we've got a great show today, and I can't wait for you to go into it. But guys, if you're listening, please make sure you ask questions in the chat. I'm going to throw this out there before you do your introduction, Joe. I'll say it again, but do some questions in the chat. We will make sure we share. But you know, I'm going to turn it over to Joe because I'm really excited about today's show.
Awesome, good stuff, and I'm excited about the special guest we have on today. Super excited about it. He's an account executive at Angel Oak Mortgage, where he was a top producer for 2023 and is the top producer in Texas. Everyone, please welcome to our show, Armando Aviles.
Good morning. Thanks, guys.
Good morning, Armando.
With you guys.
Well, you know, we're happy that you're able to come on and share today some of the great things. But before we get into today's topics, tell us a little bit about yourself. Tell us where you're at and, you know, family. That's what Joe and I are all about, is family.
The funny thing that you guys are talking about daughters, I have three daughters and 2 granddaughters. So I can relate to raising daughters. So I've been with Angel Oak since 2018. And as Joe mentioned, a top producer in Texas and was a top producer for Angel Oak in 2023. And basically, I love talking about non-QM and, you know, self-employed borrowers. I feel like are really underserved. There's lots of opportunities. There's lots of misinformation or just not information out there on the programs that are available for them. So super excited to talk to you guys about self-employed borrowers.
Well, that's awesome. Well, the one thing with the self-employed borrowers is people don't know the different products out there that come up. And everybody that's self-employed, you want to do your taxes correct, so you're not overpaying on taxes and things like that. So when it comes to our loans, we're having to use a net of your tax return versus the gross, like we do on W-2 employees, which is always the more difficult part, and that, Armando. So kind of tell us about the product that you recommend a lot of times with self-employed, and that way we can get into some of the things that they can look for.
Yeah, definitely. There's a couple of things about self-employed borrowers. First of all, that are always true. Is there's always more money in the bank statements than there is in the tax returns. That's 100% of the time. That's the case. As you mentioned, self-employed borrowers take advantage of our tax laws, and there's more cash flow in the bank statements. The second thing is, for the most part, is that self-employed borrowers have great credit. They have great credit. They pay their bills. So that combination allows us to use their bank statements to calculate income. And the biggest difference between a bank statement loan and a conventional loan is that we're averaging income generating deposits in the bank statements. So having said that, how do bank statement loans work? Well, what we do, just like I mentioned, we average the income generating deposits in the bank statements, average them out for 12 months, and then apply an expense ratio. That's the main difference. Everything else is documentation wise is pretty much standard.
Okay. When you say expense ratio, that way we can share a little bit more with the people listening, especially if there's realtors listening. What is kind of the common factor that you guys do without any other documentation on that expense ratio? After you do the average, what is the most common expense ratio that you guys do to take away from the income?
Well, we actually we default to a 50% expense ratio on all of our income reviews. We do, however, have the ability and flexibility to adjust that north or south depending on the type of business. So all businesses, all self-employed borrowers have expenses, so we have to account for those. So let's take into consideration your work from home, stay from home realtor that doesn't have any employees or overhead. Well, we have the ability to give them a 15% expense ratio, meaning we're giving them credit for 85% of the deposits, whether it's bank statement or 1099 income. On the opposite end of that spectrum, we have the borrower that owns a restaurant or a bar or a car dealership. Well, they have brick and mortar locations, and they have overhead and employees that we have to account for. So they're going to get the top of the spectrum in regards to the expense ratio at 70%, meaning that we're giving them credit for 30% of the deposits for income. Now, having said that, your restaurant owner has lots of cash flow going through their bank statement. So I rarely run into a situation where we've applied a 70% expense ratio to somebody that has higher expenses and the ratios are out of whack. The income still works is what I'm trying to say there. So, and again, we're looking at the income generating deposits. We're not necessarily looking at ending balances. We're looking at the income generating deposits.
And that's a great thing to save there, is you're looking at the cash flow and the deposits coming in. So if you're averaging $50,000 a month in consistent deposits, not one big one-time deposit, that's right. A lot of it, and that brings up another point. When you're doing the average, we'll get back to the expense ratio. When you're doing the average on the deposit, what are the things that as a lender or as a realtor or as a self-employed that we need to look out for that could be taken away from the average? Do you guys look at like large deposits? Like if there's all of a sudden $100,000 deposit for 1 month, but all the other months were usually around 30,000 and stuff like that. Do we have to figure out more questions around that one deposit? Do you see that ever in the loans that are going through your company?
Yeah, we see that all the time. I mean, we get large deposits. I mean, so when you think about the concept of a bank statement loan, and calculating income using bank statements, you want to look at the deposits that are consistent. So if your borrower consistently is averaging about 25 grand worth of deposits, and then all of a sudden there's one for $100,000, well, we're gonna pull that out and we're gonna look at it more closely. I'm not saying that we're necessarily going to not use it or not use part of it, but we want to know more. Why is that? You know, a lot of times you have contractors that will have a large deposit like that at the end of a contract, and we can get supporting documentation to document what the source of that deposit is. So it's not necessarily that we're not going to give them credit for it. We just have more questions on it. We need information on it.
Yeah, and that's what I wanted to know, just for anybody that's listening, because that is a big thing. Is all of a sudden they get an SBA loan and they put it. You know, we dealt with it with COVID, right? You got the PPP loans that you didn't have to pay back, but all of a sudden that throws off your average and your deposits. And so I just want to make sure people are aware. If you're getting paid accounts receivables and you're getting lump sums that are larger than usual, just make sure that you know if you're doing a loan that we're going to have to ask more questions around it so we can utilize that funds. And that's why I wanted to ask that question.
Right. And you know, I recently had a financial planner that received bonuses twice a year. We initially looked at 12 months of the bank statements, and we backed up those two large deposits. So what we ended up doing is getting the previous 12 months and showing that was a normal occurrence for them annually, twice a year, how they were compensated as part of their compensation. So, I mean, you know, the main thing about bank statement loans is that there's lots of flexibility. You know, we're really looking at scenarios that make sense. We want to do loans that make sense, and just get creative with, you know, how we can make those loans work.
Now, I know because we on a previous episode a week or two ago, Joe and I had talked about in regards to like a standard conventional and FHA loan, their minimum down payments being 3.5%, right, and stuff. But what is it? So what's a minimum down payment for these bank statement loans?
My minimum down payment is 10%. Okay. And, you know, when you keep in mind the comment that I made about your self-employed borrowers having money in the bank and paying their bills, you know, we have to, there's inherent risk in doing a loan where we're looking at bank statements versus tax returns. So the borrower has to have skin in the game, and that's part of the you know, what we look at and consider. So 10% is the max in regards to the minimum down payment.
Now, when we as we're talking about self-employed borrowers, I mean, you brought up as far as like a realtor, financial planner. Give our audience an example of what does a typical borrower look like?
Yeah, great question. You know, you'd be surprised. I do a little sidebar. I do a lot of presentations, realtor lunch and learns, and sometimes I travel. And Uber drivers are huge. So it's pretty cool to have a conversation in an Uber ride and just say, hey, you're 1099, right? Of course, I know they're 1099, but just to get the conversation going. Yeah. And they don't know that they can qualify for a loan using their 1099s or bank statements. So Uber drivers are great self-employed example of self-employed borrowers. But I'm in the Dallas-Fort Worth area, and it's a big trucking hub up here. So you have your truck driver that's either the owner operator or your truck driver that is 1099 and you know, just, you know, drives a set route every day. Nail techs, realtors are huge. Restaurant owners, bar owners, car dealerships. You know, that's just in your everyday life. You know, when I do realtor presentations or lunch and learns, I usually will look at one of the realtors and say, who does your nails? You know, have you had a conversation with your nail tech? You know, they're 1099. They're 1099. They're great borrowers. They're great borrowers, and they don't know. The thing is that they don't realize that they can qualify for these types of loans with bank statements or with 1099s.
Right. Now, you know, you bring up the 1099. Can you explain to our listeners the difference between using a 1099 versus a tax return? Because a lot of 1099 employees fill out a Schedule C. And then they do their deductions.
So what we'll do is, so that's a different way to do a bank statement loan for us is a 1099. It's a simpler way to do one in that we will look at the 1099 instead of the tax return as a whole. We will get the 1099 and then we'll use a year-to-date pay history from their employer or year-to-date bank statements. And we'll use that to calculate the income. Now we'll get a 4506 on the 1099. We'll verify the 1099 is accurate, but we won't verify the tax returns. Okay. So it's a simpler way to do a bank statement loan. So yeah, I mean, it's 1099 borrowers are great. And the thing about 1099 borrowers is they usually have a really low expense ratio because they work from home and they don't have any employees.
Right. Or the company, brunts the expense and they're just getting paid separately. Yeah, that's a nice way to do the gross for a self-employed if you're truly a 1099.
Right.
There's a lot of them out there that I don't know they can get a loan with using the 1099 because they're like, oh, I haven't filed my taxes. That brings up a good point. We keep talking about self-employed, but what is the length of self-employed that they need to be in there? And does it have to be the same company?
That's a great question. We traditionally require 2 years of self-employment, but we've recently rolled out a program where all they need is 12 months of self-employment as long as they've been in the same industry for the last 2 years. So a good example of that is your truck driver. Your truck driver that's a W-2 and saved his or her money and went out on their own. And now they're Schedule C or they formed an LLC or they're 1099. Right. Financial planners are a good example of that as well, because sometimes they'll go from W-2 to 1099 within the same company. So it's a great new feature because it takes into consideration, Texas leads the nation in new self-employment applications. And when you consider that since COVID, the amount of applications for self-employment is just skyrocketed. You have a lot of those borrowers that have 12 months of self-employment. And again, they don't know that. They don't know the ramifications of going 1099 or going Schedule C after being W-2 for the big major part of their career, until they come to you and now their tax returns don't work. Right.
Right.
So that's definitely an alternative. And, I advise my loan officers always to, if you have a self-employed borrower, get the bank statements. I can conservatively say that we can double or triple their spending power in their bank statements. And why not present them with both options? And I would extend that advice to your borrowers out there, all your listeners. If you're self-employed and you want to get a mortgage, insist that your loan officer get you a pre-approval using bank statements. Let's look at both scenarios.
Well, that's a great point. I think self-employed people, you said it right. They pay their bills, they do things because they're trying to keep their business going.
Right.
Credit wise, I see sometimes that the credit scores, I would love a mathematician to come on and tell us how FICO scores truly are.
Oh, right.
Because everybody's got a different, they're done all different ways, but it is true. When it comes to FICO scores, especially those businesses that utilize credit cards, the balances get up and then they pay them down. They get up, they pay them down. That affects their credit scores in some cases.
Right.
So it is kind of, I know I'm bouncing back to a different topic. This is where I go off script. But what is the FICO score minimum that, we need to be looking for some of these products? Because if we start at the minimum, anything above is just helpful.
Right. So our minimum FICO is 640. And I get a lot of phone calls and I have conversations with my loan officers that say, hey, I got a guy that's got a 600 score. He's self-employed. That's not an automatic no for me. That scenarios. I'm like, okay, is there any room for improvement in their credit score? If there is, let's look at the bank statements. Let's look what the cash flow looks like to make sure that the income works. And then you can have that conversation with your borrower to say, hey, if you do this or pay this balance down or whatever it may be to get your score up, this is what we can do for you. And a lot of times I'll start a loan with a borrower that's got like a 660 score, for example, and they're trying to get to 85% loan to value and you need a higher credit score. And we'll start the loan and the borrower is in the process of doing a ReScore And once we get that rescored credit report, we can adjust the LTV and the pricing while in the loan process.
Okay.
So, my main thing is let's look at the bank statements. Let's look at the income and have conversations, because sometimes it's not a no right now, it's a maybe, but if you do this, this, and this, and you take these steps, this is what we can do for you.
Yeah. And Joe and I, we have access to different simulators that we can help clients build out a plan to get their scores up. And I know a lot of people do. If you're working with a lender that just passes you off to a credit company, find out why they don't have a simulator to help you, or get with a professional loan originator that can help with that. There are, and if we recommend a credit person, it's not that we're affiliated with them. I'm just putting this disclaimer out there.
Right.
We're not affiliated with them, but it's somebody that we've trusted to help some of our clients before. And Armando, you probably have the same thing. Loan officers have different people that can help build that out. So don't get discouraged. That's the great way that you can say this. Don't get discouraged if you think your score is below a 640.
Right.
Let us build a plan. Let us work with Armando and Angel Oak and figure out what's the best, timing for you. So that's a great point about credit scores. Don't get discouraged. It's not an automatic no. It's just a maybe not right now.
Right.
Mentality.
Let's build a plan, put it together so that if it isn't today, maybe it's a couple weeks or a couple months down the road, that then we can actually get you in the right position, to be able to put an offer in on a home. Yep.
Correct.
So, we're talking about self-employed. I want to know, why is this so important to you, especially here in Texas or anywhere? But why is it important for us to be talking about self-employed and the different types of products for them?
Yeah, great question. It's important. And let me read off some statistics for you guys. 36% of workers are gig economy workers in some capacity. Just
that's
one of that. And those numbers have just skyrocketed since COVID, after COVID. And just think about that. You talked about your nail techs, you talked about your Uber drivers. Just quantify that in regards to how many of those borrowers that don't know that there's options for them.
Right.
59 million people categorized in the gig economy. That's huge.
59 million. That's huge.
Right.
I can't put my head around that many people.
Right. It's just, and the thing about it is that, what I keep going back to is that they don't realize that they have options, and as I mentioned earlier, if, you run across your self-employed borrowers, even if your tax returns work, let's look at bank statements, increase your spending power. Who doesn't want a bigger house?
Right.
It's just a win-win for everybody. 17 million Americans categorized as self-employed. It's crazy, and that number is just growing. Texas is number 3 in the nation. The state of Texas is number 3 in the nation, behind California and Florida, for self-employed borrowers.
Wow.
And those are huge numbers when you look into it. It's baffling to think that 17 million people categorized as self-employed, because some 1099s don't categorize them. So I'm wondering how many of that number could go up because of that.
Right. I have, and here's one more point that I'd like to make is, what percentage of those borrowers that are considered self-employed have equity in their homes that they can't tap into?
Or how many of them that don't own a home?
Right.
Because they don't know that the income they have, even though they're self-employed, that can actually qualify. Right. And a lot of people, like you were saying, Armando, that have these gig jobs, because in the past, since COVID, with the way our economy has been, they've had to pick up a second job.
Right.
To be able to do it. And we can actually count that income in qualifying you.
Right. We can actually combine W-2 and self-employed income.
There you go. Yeah.
So that brings up another question. When it comes to bank statements and things like that, if they co-own with somebody, or if their spouse is on the account but not an owner, is that going to affect the business bank statements? Because some Schedule C employee or businesses, they have a bit personal account, I guess, and they have their wife on it, but they're the only owners of the business. Does that cause issues with getting the loan?
Well, it not necessarily cause an issue, but on personal bank statement loans, if the spouse is on the loan, they have to be. If the spouse is on the account, then they have to be on the loan.
Okay.
So, and then in regards to percentage of ownership, when we're using business bank statements, we do have to take that into consideration because we have to divvy up that income that's to match the ownership. So one thing that I do with my loan officers is that I request both. Get me the business, the last 12 months of the business, and get me the last 12 months of the personal. So the thing about that is if I have the business account and let's say they're 50% owner of the business, and then I pull the personal account, there's some occasions where the income, I can give them more income in the personal account because now there's not an expense ratio. Because all the money that's gone into that personal account is 100% theirs.
That's good.
And the expense ratio has already been accounted for in the business account. So, I always want to look at both and let me decide what's the best course of action. I mean, and the way that looks like we have a group that's all they do is analyze bank statements. So it's all you have to do is get them for us.
Right.
And let us look at the scenario as a whole and determine which way is the best way to go on that.
Okay.
Good.
That's awesome.
Well, guys, I know that we're starting to kind of wind down, get to our time limit there. Armando, I really appreciate you coming on the show today and all your insights that you're able to give for all of our listeners. Really do appreciate it. I'm sure it's going to help somebody out there to realize that even though they are self-employed, whether it's a gig job or what have you, that they can actually qualify for a mortgage. So great stuff there. If any of you have any questions in regards to these types of loans, these bank statement loans and that, feel free to reach out to Joe and I. Our email address, the Mojo Show podcast @gmail.com. More than welcome to shoot us some questions. Be glad to run through some scenarios with you on it. Next week, we're going to continue on with our series on decoding mortgages as we dive into mortgages used for investment properties. We'll have our special guest, Ashley Henderson, on. So be sure to tune in next week at our usual time, Wednesday, 9 a.m. Central Standard. I want to thank everyone for tuning in today and listening to the show. If you want to catch up on any of our past episodes, especially as we go through this series on decoding mortgages, you can definitely catch up on our shows by going to our YouTube channel, The Mojo Show Real Estate Podcast. And while you're there, hit the subscribe button because we are on a mission to get to 1,000 subscribers by the end of the year. And with your help, I know we can get there. Before we close out the show, Joe, any last comments, sir?
I would just say anybody that's a broker out there, if you're not using a great AE like Armando, please reach out to us. We will give you his information if you do not have a representative with Angel Oak. And we really do appreciate you coming on today. I cannot thank you enough because this is a big topic that we need to do things with, especially when you say 17 million people. I'll take a 10. I'll take 1/10 of 1% of those people to get this done.
Definitely.
I'll take the rest of the crumbs.
Well, I appreciate you guys allowing me to come on here, and it was great. It was great to educate any of the self-employed borrowers out there, and definitely if any brokers out there that don't have representation at Angel Oak, reach out to these guys and get my contact information. I'd be glad to help you guys.
Yes,
absolutely.
Perfect.
All right. Well, let's close the show out with I'm Joe Mortgage, and that handsome guy over there with the beard is Cup of Joe Mortgage. And we'll see you next week.